Imagine a world where your investment returns are maximized, not just by market performance, but also by minimizing the impact of taxes. Welcome to the realm of tax-efficient investing. In this journey, we'll unravel strategies from Tax-Free Wealth, the Little Book of Common Sense Investing, and the Taxable Investor's Manifesto to help you navigate the intricate landscape of taxes and investments. Let's dive into the world of tax efficiency and discover how you can keep more of your hard-earned money. Understanding the tax landscape. Imagine a world where every financial move is accompanied by a silent tax collector, patiently waiting for its share. The tax landscape is complex, with various types of taxes impacting your investment returns. Capital gains, the rewards of your investment journey, come in two flavors, short-term and long-term. Short-term gains are taxed at your ordinary income tax rate, while long-term gains typically enjoy preferential tax rates. Dividends, those periodic payouts from companies, can be classified as qualified or non-qualified. Qualified dividends are taxed at lower rates, aligned with long-term capital gains rates. Non-qualified dividends, on the other hand, are taxed at your ordinary income tax rate. Then there's interest income, the earnings from bonds, certificates of deposit, and other debt securities. Interest income is usually taxed at your ordinary income tax rate. It's not just about the types of taxes, it's also about different investment accounts. Taxable accounts subject your investment gains to taxes in the year they're earned. Tax-deferred accounts, like traditional IRAs and 401(k)s, offer a temporary shelter from taxes, allowing your investments to grow without immediate tax implications. And then there are tax-free accounts, like Roth IRAs, where qualified withdrawals are tax-free. Tax-efficient investing strategies. Tax-efficient investing is like a puzzle with pieces that, when put together correctly, minimize your tax bill. Tax loss harvesting is one piece of the puzzle. It involves strategically selling investments that have declined in value to offset gains, thereby reducing your taxable income. This technique can be particularly helpful in taxable accounts. Asset location is another puzzle piece. Picture your investment portfolio as a city with various districts, taxable, tax-deferred, and tax-free. Placing specific investments in specific districts based on their tax efficiency can lead to significant savings. For example, tax-inefficient investments like bonds might find a home in tax-deferred accounts, while tax-efficient ones like index funds could reside in taxable accounts. Impact of taxes on investment returns. Imagine you and a friend invest in the same mutual fund. Over the years, the fund performs well and generates significant returns. However, your friend's returns are larger because they paid less in taxes. The impact of taxes on investment returns is real, and it can erode your gains over time. As you review your investment performance, it's crucial to account for taxes to get a true picture of your net returns. Tax efficiency isn't just a buzzword, it's a strategy that can potentially lead to higher net returns. The Little Book of Common Sense Investing reminds us that every dollar you save in taxes is a dollar you get to keep and reinvest. This approach aligns with legendary investor John C. Bogle's philosophy of focusing on minimizing costs, and taxes are a significant part of those costs. Tax-efficient investment vehicles. Imagine a toolkit filled with specialized instruments designed to shield your investments from the impact of taxes. Tax-advantaged accounts are those instruments. Traditional IRAs, 401(k)s, and similar accounts offer you the ability to contribute pre-tax dollars, reducing your current taxable income. These accounts grow tax-deferred until you make withdrawals, which are taxed as ordinary income. Then there's the Roth IRA, a unique tool that flips the script. You contribute after-tax dollars, but qualified withdrawals are tax-free. This account type is particularly attractive if you expect your tax rate to be higher in retirement. Health savings accounts, HSAs, are like a hidden treasure for medical expenses. Contributions are tax-deductible, and withdrawals for qualified medical expenses are tax-free. Utilizing these tax-advantaged accounts strategically is akin to building a fortress around your investments, protecting them from the tax collector's grasp. By understanding the tax implications of each account type, you can align your investment strategies with your financial goals. Dividend and interest income strategies. Imagine your investment returns as a beautifully crafted mosaic, with each piece representing dividend and interest income. Now, imagine that you have the ability to color some of those pieces in shades that minimize taxes. Dividend and interest income strategies are like the artist's brushstrokes, carefully applied to achieve maximum tax efficiency. Qualified dividends, those that meet specific criteria, enjoy preferential tax rates similar to long-term capital gains. By focusing on investing in companies that offer qualified dividends, you're effectively painting your portfolio with tax-friendly hues. Additionally, municipal bonds shine as stars in the tax efficiency sky. Interest earned from these bonds is often exempt from federal taxes and, in some cases, state and local taxes. They're like the golden frames that highlight your investment masterpiece. Capital gains and losses management. Capital gains and losses are the ever-shifting sands in the investment landscape. Picture them as a tide that comes in two forms, short-term and long-term. Short-term gains, earned from assets held for less than a year, are taxed at your ordinary income tax rate. In contrast, long-term gains, generated from assets held for over a year, enjoy the privilege of lower tax rates. Managing capital gains and losses is like taming the tide to your advantage. Timing is key. Selling assets that have appreciated for over a year means you'll likely be swimming in the long-term capital gains pool. On the flip side, strategically selling assets with losses can offset gains, leading to tax savings. And if your losses exceed your gains, you can even deduct the excess from your ordinary income, reducing your taxable income. Estate planning and wealth transfer. Estate planning is like crafting a legacy, a symphony of strategies that ensure your wealth continues to flourish even after you're gone. Estate and inheritance taxes can loom like shadows over your legacy, but savvy planning can cast them aside. Trusts, like characters in your legacy's narrative, play crucial roles. Revocable living trusts allow assets to pass to heirs without going through probate, potentially saving time and costs. Irrevocable trusts, on the other hand, can provide a sanctuary for assets, shielding them from estate taxes. These trusts can also offer income for beneficiaries while minimizing tax liability. By utilizing these tools, you're orchestrating a seamless transition of wealth that not only preserves your legacy but does so with tax efficiency in mind. International tax considerations. Imagine your investment journey crossing borders, embracing opportunities beyond your homeland. International tax considerations come into play as you explore investments beyond your country's borders. Different countries have different tax rules for investment income and gains. While some offer preferential tax treatment for foreign investors, others might impose withholding taxes on dividends and interest. Navigating these international waters requires knowledge of tax treaties and local regulations. Holding foreign investments through tax-efficient accounts like Roth IRAs or tax-deferred accounts can shield you from some of these complexities. By understanding these considerations and utilizing tax-advantaged accounts, you're like a seasoned traveler exploring new horizons while keeping your financial compass steady. Staying updated on tax changes. Imagine the tax code as a living entity, evolving and adapting over time. Staying informed about tax changes is like keeping a watchful eye on a chameleon. It can change its colors quickly. Tax laws are dynamic, with updates that can impact your investment strategies. Subtle changes can affect deductions, tax rates, and more. Actively seeking tax-related information through reputable sources is like arming yourself with knowledge to navigate the ever-changing tax landscape. Consulting financial professionals, subscribing to financial news, and regularly reviewing your investments in light of potential tax implications are all ways to ensure that you're not caught off guard by unexpected changes. And there you have it, a voyage through the realm of tax-efficient investing. Armed with insights from Tax-Free Wealth, The Little Book of Common Sense Investing, and The Taxable Investor's Manifesto, you're prepared to navigate this intricate landscape. Remember, this is just the beginning. These books hold a treasure trove of strategies that can help you optimize your investments for tax efficiency. As you embark on this journey, consult with professionals to tailor strategies to your unique financial. Before you dive into the world of investing, here's a friendly reminder. This content is educational, not financial advice. Your financial situation is distinct, and it's essential to consult experts before making any investment decisions. So, equip yourself with knowledge, consult professionals, and navigate the investment landscape with wisdom.